Welcome back. The total value of Nigeria's capital importation slid by more than 77% in the second quarter of 2020 to $1.29 billion. And that indicated a reassessment of the Nigerian economy as a preferred destination due to the ravaging COVID-19 pandemic. And for the first time in a long while, actually, the largest amount of capital importation by category is recorded in other investments, which accounts for over $761 million, or 58% of total capital imported. The data, which comes from the National Bureau of Statistics, puts portfolio investment at $385 million and foreign direct investment, or FDI, at $148 million, representing just around 11% of the pie. Well, a professor of capital markets at Nasarawa State University and the president of Nigeria Capital Market Academics, Professor Uche Waleke, joins us now to make sense of all of these data. Good morning, Professor. Thanks for joining us on the program. Now, this is the first time that other investments as a category will be outpacing FPIs in Nigeria's capital importation. What do you make of the data?
Yeah, thanks, BC, for this invitation. I think you hit the nail on the head when you talked about, when you referred to ravaging COVID. That's principally to blame for what has happened. Casting my mind back to 2016, when we were also in recession, capital importation also fell. In Q2 of 2016, it was just $1.044 billion. And you also notice that the trend in the last few years appears to oscillate with oil prices. So anytime you find oil prices dipping, capital importation also tends to drop. That was also the experience in 2016. Coming from 2015, when capital importation was on a quarterly basis, was in excess of $2 billion. So in 2016, when oil price fell, capital importation also fell. So that's also what we're seeing now. The decline in oil price, particularly in Q2 of 2020, and of course the general economic downturn. You saw the GDP figure, economy contracting by 6.11%. The other negative news, as it were, unemployment rate in the same Q2 rising by as much as, if you take the total thing, over 55%. I was talking about unemployment 27.1 and underemployment 28%. Not talk of also the rising inflation. Purchasing managers index, of course, as you know, a measure of manufacturing activity in Q2 was also bad. We are beginning to see some recovery now to about 48 points, even though it's still below the 50 points indicative threshold. So I want to believe that in the coming quarters, in Q3, we are likely to see a better performance. And particularly talking about COVID, you also find that the major countries that represent the origin of this investment, have been over time, have been UK and the US. And these are also countries experiencing some challenges due to COVID-19. The UK, as you know, contracted by over 20% in Q2 of 2020, and the US by over 30%. So that's having their own challenges. That affected capital importation. You talked about other investments, that's correct, and it was more from loans. We didn't really see anything with respect to trade credit, currency deposits, and it was principally loans and a little from other claims. FPIs, of course, as you know, have always dominated over time. That's foreign portfolio investment. But even with the foreign portfolio investment this time, which placed second, much of it came from money market instruments. Unlike before when you find them coming from equities. And interestingly too, there was nothing from bonds. Again, that corroborates what you find in the stock market. That corroborates the report by the Nigerian Stock Exchange, for example. If you look at the Nigerian Stock Exchange FPI and domestic investors transactions report, the latest we have on their website is as of June. If you look at the second quarter between April, May, and June, you'll also find that domestic investors have actually had the upper hand. As a matter of fact, since January this year, domestic investors have led transactions on the floor of the exchange, unlike what happened in 2019, when for the whole of 2019, apart from just 3 months, May, June, and December, where we had domestic investors occupying this space, foreign investors dominated the market in 2019. But coming into 2020, that's this year, all through the year, it's been domestic investors and principally, of course, institutional investors, pension fund administrators, and mutual funds.
But then,
and
Professor,
of course,
one would
we
ask,
also saw some retail investors.
Professor Waleke, one would ask that how peculiar is this situation to Nigeria, given that the Institute of International Finance reported recently that non-resident outflows from emerging markets stood at about $90 billion in the first quarter and the second quarter, but no significant inflows within the period?
Yes, as I said, you can still tie everything to the COVID. And if you look at the sectoral attraction of these foreign investors we are talking about, of course, the bulk of it came in the form of shares. And then the second followed by the banking and financing sectors. And again, you also notice that it's also consistent with even the GDP report that we had. The GDP report talked about a lot of sectors being in the negative territory, unlike the financial sector or financial institutions. As a matter of fact, financial institutions appreciated or gained by over 28% in Q2 of 2020. And you just had the group deputy CEO of Access Bank, talking about how they are leveraging IT, how a lot of customers are even coming in now. So the financial sector, as it were, have not been, that sector hasn't been as hit as other sectors. We also, recorded some positive growth in telecom and financial, and even agri, even though agri was a marginal increase. So the point I'm making is that, yes, we have the financial sector really wasn't as hit as the other sectors. And of course, you also know that capital importation is done through banks. 3 banks actually accounted for the bulk of what we had, namely Citibank, Standard Chartered, and Stanbic IBTC. Interestingly, it's just Stanbic IBTC that is quoted on the stock exchange and is also reflected on the price of Stanbic IBTC. So what that also tells us is that our banks, many of them, need to find their feet in the international, in the global space, which is why I'm happy that Access Bank, is talking about, branching out, in other countries and, becoming a real global bank. So other banks should follow suit, because that is in the interest of the financial system in Nigeria. It will put them in a stronger position to attract more capital into the country, so that we don't depend just on these 3 foreign banks. And as I said, it's just one of them that has shown interest in the stock market.
Now, still talking about the data now, Lagos remains the top destination of investment, accounting for $1.13 billion, which is about 87% of the total capital, despite the lockdown that we saw in the period. Any idea what sectors actually attracted that amount?
It's clear from the reports that the shares, I said the bulk of it came in form of shares. And of course, for obvious reasons, Lagos has, the capital importation has been concentrated around Lagos for a while, for obvious reasons. This time around, out of $1.29 billion in the second quarter of 2020, we are told over 1.1 billion came through Lagos. So that's not surprising. The other states is Ogun State. Apart from Lagos and Ogun, the other ones, namely Niger, Kano, and Anambra, trailed behind. Every other state couldn't attract any investment to the states. So that of Lagos is obvious, and that's because Lagos is the financial capital of the country, the financial powerhouse of Nigeria, and that's where you have the Nigerian Stock Exchange. I said the bulk of it came through shares. So whether for foreign direct investments, for foreign portfolio investments, you have equity components. There is equity component in foreign direct investment. As a matter of fact, foreign direct investment was more of equity. We didn't have any in other investments. The foreign portfolio investment also has a little of equity. There was no bond. And as I said, we saw much of that too in money market instruments, talking about treasury bills and things like commercial paper. So for obvious reasons, that's why we have that, in Lagos. But one should also expect that, going forward, we should have capital importation in virtually all the states of this country, because we have resources that are evenly distributed across the country. And these are resources that need to be harnessed, and we need investors, both local and foreign, to be able to harness them. Whether agriculture, if you look at the sectoral allocation, agriculture just got about $48 billion. Okay, we have little in production, for example. Telecom also got some. So what I'm saying is, we have resources all over the country that can be tapped. So it is for those managing the states to be up and doing, to see how much they can attract investment into their state. And for me, the investment that matters. The quality of the investment is very key, it's very important. This country can only develop on permanent capital, not fluctuating capital. Fluctuating capital is foreign portfolio investment, which, if you know, as you know, is ephemeral, is hot money, if you like. So and over time, part of why we have had this high rate of unemployment in the country is because investments have been more of foreign portfolio investment, briefcase investment. So we need more of long-term investments, foreign direct investments, the way countries like India, Malaysia, Indonesia, attract more of FDIs. That is what we need in this country, because if we have FDIs in agriculture, we have in solid minerals, we have in IT and so on, that is when you see unemployment rate going down, because that is the ones that really create jobs. Foreign portfolio investments are good, yes, because they will help boost activities in the market, but we need more of foreign direct investments, and that is where, as I said, the state governments should be up and doing.
Now, having said that, now, when you look at it, I mean, this capital importation data clearly explains the foreign exchange rate volatility, of course, given the measures taken now by the central bank, which is the removal of middlemen in the Form M processing and the resumption of FX sales to the BDCs this week. What is likely to change?
Yes, what is likely to change is going forward, I expect that the moment we see some clarity in the forex market, that should ordinarily translate into increase in capital inflows, into the country. Of course, helping balance of payment and also helping external reserves. I just saw this morning that external reserves, have begun to inch up. So that's good news. Maybe, of course, on account of favorable, oil price, recovery in oil price. So as we get liquidity in the forex market, as we get clarity in what happens there, of course, foreign investors will begin to show interest. On the condition, of course, everything depends on, COVID. COVID for me is the overarching factor on the condition that we continue to contain globally the COVID-19, because if it is not contained, even when you put your things in order here, the investors will be sitting on the fence. They are still scared of coming to invest. So, but once a vaccine is developed and the situation is contained, I'm sure they will come. And once they come, the positive impact it will have on external reserves, giving the central bank more power to intervene and put liquidity in the market. So, more foreign portfolio investments, foreign investments will translate to increase external reserves. So as the central bank tries to manage the demand side, for example, saying that trying to use asking people to raise Form M only in favor of the major supplier, as opposed to middle M, that's the demand side, or also trying to manage the supply side by asking every exporter to ensure that all proceeds are repatriated. Okay, that will help our forex.
All right.
And with the plan to unify exchange rates. Exchange rates. I'm sure once that is done, investors will be induced to come to Nigeria.
Okay, that will be a good point to leave the conversation. Professor of Capital Markets at Nasarawa State University and the President of Nigeria Capital Market Academics, Professor Uche Walike. Thanks for coming on the program.
My pleasure.
Time now for a review of last week's activities at the Nigerian equities market with Edidiong Ewan. Good morning, Eddie. Tell us what drove up the numbers last week.
Good morning, BC. Well, most global markets were positive last week on improved prospects of global economic recovery. So it's very possible that, that's what also drove the market in Nigeria, especially as we've seen a reduced number of daily confirmed cases of COVID-19. Last week, Nigerian stocks inched up for the sixth consecutive week to 0.35% at 25,309.37 points. Now, the month-to-date gains moderated to about 2.5%, while the year-to-date losses, reduced to minus 5.7%. The equity cap was at 13.203 trillion Naira last week. Now, at the activity chart, we can see that volume was higher compared to the previous week at 1.07 billion units, worth 7.384 billion Naira. Now, you notice that the value was lower last week, and we saw 16,684 deals. Sectoral performance was broadly positive. Only the banking index declined 0.23%, consumer goods, industrial goods, insurance. And for the industrial goods counter, we saw a lot of bargain of interest in Boa Cement last week, so that was also what led to the increase on that counter. Insurance was up 2.80%, while oil and gas was unchanged. At the NSEOT market, we saw yields increased by 0.28% last week to 711.15 points, with the market cap at 522.39 billion naira. Volume, value, and deals were higher last week. We saw 250,906 units worth 5.35 billion naira, all traded in 23 deals. But then let's talk to Adedoyin Araoluwa, the Deputy MD at AfriInvest Securities, for more on the equities market. Good morning, Adedoyin. Thank you for joining us on the program.
Okay.
We've seen a fairly bullish market lately, all through, the greater part of last week. Is that same pattern likely to continue this week?
Okay, thanks. Well, out of 5 trading sessions last week, we saw 4 close in the bullish segment. Week to date performance was 0.35%, bringing year-to-date returns to negative 5.7%. Average volume traded in the market has declined over time by 32.7%, from 25.52 billion in Q1 2020 to 17.16 billion in Q2 2020. This can be further buttressed by the capital importation report released by the National Bureau of Statistics on Friday, showing a decline of foreign flows into the equities market by 89.3%, from $469.8 million in Q2 19 to $52.3 million in Q2 20. Going into this week, we think investors will be a bit cautious on the back of the gains in the previous week, while some will still take position ahead of the release of the half-year results for some of the Tier 1 banks.
Okay, do you have any information on the delays around the release of the Tier 1 banks' half-year results?
Okay, most of the Tier 1 banks have notified the exchange and investors that their board have approved the half-year results, as well as possible declaration of interim dividends, but it's subject to the final approval of the Central Bank of Nigeria. As soon as CBN approves, the results are expected to be published. It's also worthy to know that the official deadline for listed companies to submit their audited half-year reports, according to the Securities and Exchange Commission's rule, is 60 days after the end of the half-year, which lapsed today. We expect the results to be published as soon as the CBN approval is gotten.
All right, Adedoyin, thank you for that information. Enjoy the rest of your day. Adedoyin Araoluwa is the Deputy Managing Director at AfriInvest Securities. So we'll leave you there for now. Over to you, BC.
Of course, we have a few hours to see what direction the markets would take later today. Of course, we hope that it would be a positive one. But then we'll be crossing over to London when we come back shortly, as well as touch the debt and currencies market. Don't go away.